Hey, John, great to see you again as always.
Thank you, Carl.
I'm really excited about, 2026 as we head into it. Current cash positions in the marketplace are $21 trillion in cash and cash equivalents. The Fed has taken action the last couple of years to shorten rates. Do you think that the muni market will be the beneficiary of movement of those funds, and maybe top line or yields and credits, supportive of that move?
I think so. We've actually seen it sort of behind the scenes in 2024. There was approximately 40 billion in total inflows when you combine open-end funds and ETFs for municipals specifically. In 2025, there was moderate improvement in that, about 50 billion in inflows, is somewhat swamped by the heavy new issue supply of those 2 years. Now, in January, inflows are also starting off on a very good note. It looks to be approximately between 12 and 13 billion in inflows for the month of January 2026. Now, that was also a month of heavy supply, but we're starting to see that migration. Some of that migration could be because cash balances, as you mentioned, are much higher than normal. And part of it is because the total Fed cutting over the last couple of years has been 150 basis points. That is filtering its way through to short-term product rates, whether it be taxable or tax exempt. Just looking specifically at the type of paper the tax exempt money market funds purchase, those yields have fallen to approximately 2%. They've been as low as 1.5%, as high as 2.5%, bouncing around between those two goalposts. So I think that is bringing those short rates down, and that is steepening the yield curve. So there's a reward for fixed rate. Just takes a little bit more of a longer term asset allocation. But I would say liquidity conditions in municipals have been fairly good. Now we've had some volatility over 2025 with some events related to tariffs, related to tax policy analysis, but overall, people are still putting money to work.
It's great. And I've noticed the 10-year, which gets all the press along with the Fed, has had increased volatility here in January. Do you have a view about rates, the Fed, and maybe more importantly, the economy in total?
Sure. Well, there are many cross currents affecting the 10-year treasury. It seems to have settled into a range when people are more nervous about the slowdown in the job market. The 10-year treasury tends to inch down to a base or a floor of around 4%. Supply considerations and nervousness around the future outlook for inflation can push the 10-year treasury up to around 4.5%, but we've seen it stay within that range for quite some time, likely to still be the case. On Fed policy, I think they're going to be biased to look for the weakness and be preemptive to prevent any undue weakness in the labor market. We are still seeing job growth, it's just very modest. And we have seen the unemployment rate tick up a few tenths of a percent over the last year or so. So they're very cognizant of that. And of course, with politics the way they are, they're going to be perhaps tilted towards that dovish bias. Having said that, it's 12 different members and they have independent views, and you have to build a consensus. And inflation has settled into a rate that is a bit higher than target. The improvement has been substantial, but the improvement seems to have tapered off right around 2.5, 2.6, 2.7, depending on the specific index over the trailing 12 months. But in that range versus the 2.0 that the Fed would really like to see before they keep cutting rates. Now, I do think on the inflation front, there are reasons to be somewhat optimistic. About a third of inflation comes from housing. Housing data is so lagged, it's still showing 3-4% increases in rental costs, but we actually know from Zillow and Redfin and other services that rental offerings are generally flat. Housing starting to see some discounts on the secondary market for home purchases. So that those numbers should be coming down. Tariffs are a wild card, but they've been in flux since April of last year, and probably seen the worst of it from the tariff pass through onto the consumer, probably. So Productivity on the other side, productivity is running really strong, almost 5%. So unit labor costs are actually falling 2%. So there are some reasons for optimism that we could continue the disinflationary trend. And then due to politics and some other things, the Fed's going to be looking to protect against weakness. So biased towards a cut. All that having been said, revenues into the Treasury are strong. That's actually had a somewhat incrementally positive effect on the deficit, come down just a touch. So I think we'll probably stay in this 4 to 4.5% range while short rates migrate lower.
So one of the challenges last year, I don't know if it was a challenge, but munis broadly underperformed governments and corporates. And a lot of people speculated it was an oversupply of new issue. I think the record was 580 billion last year. Do you have a view of matching supply and demand and how you think 2026 will fare that way?
Sure. Yeah, I think the lagged performance of munis is overwhelmingly technical, and you've just seen in January of 2026, since the technicals improved with good inflows, that lagged performance munis are already starting to outperform in thus far in January. So there is potentially a little bit of catch up already brewing. On that technical front, 580 smashes all-time records, of course, up 14% from the prior all-time record. But in addition, a little bit less refunding and a little bit more new money for new projects. And so what that means is that the net total outstanding municipal paper actually grew more than it normally does. So it grew in the neighborhood of about $100 billion of growth of total outstanding. And as I mentioned, about 50 billion in inflows. So there are other ways in which people buy municipals that don't involve funds and products, of course. But so all those bonds are put away, but they were put away at slightly cheaper levels. I mean, from an entry point, I do think that overall rates look attractive. Fundamentals have been very steady. Tax exemption has essentially been affirmed as a non-issue, as historically the case. So a lot of reasons to think that it's a good entry point for 2026. A little bit of lagging performance, as you mentioned. In my opinion, that's all technical.
Well, then we should look forward to a great 2026. But how are you feeling specifically about the high yield muni market and historical rates and credit quality? Are you seeing an influx of defaults, ratings? How are you feeling about high yield muni specifically?
Sure. Well, I think what sets the tone are the revenue collections of the states. And the revenue collections of the states, similarly to how the federal government is positioned, they keep growing to new record highs. Particularly, most states have a personal income tax, and the biggest states, California and New York, two of the biggest states, I should say, have an extremely steep progressive personal income tax. And so when you see 10 trillion of stock market wealth created in 2025, when you see a relatively full employment type economy, you're seeing incredible collections. Tax collections are very high, growing at about 7.5% off of all-time record highs. The that is growing faster than budgetary expenditures. So generally speaking, budgets are okay at the state level. Now, states are, broadly speaking, not high yield credits, but they fund a lot of things within their states or help fund hospitals, charter schools, transportation projects, other things within the state that could be considered high yield. So robust state budgets are a good starting point. The You see it in upgrades exceeding downgrades for the fifth year in a row. Defaults running at a very, very low level, either as a percentage of the total muni market or as a percentage of the high yield muni market. Either way, they're running very low. And I think credit spreads overall, the best word I can use to describe it is they're incredibly diverse and dispersed. So no one number really captures what an attractive yield might be for a high yield municipal bond, because we're seeing high yield muni bonds in the 4.5% range, and we're also seeing them go all the way up to say 12%. Now, more typical 5 to 7 would be generally more typical for center of the plate, that's still a very wide range. We can find a lot of value within that 5 to 7% all-in yield realm. Call it 200 to 300 basis points of spread. I think that's good compensation for the security features and the stability and the infrastructure that is being built here.
Thank you as always, John.
Thank you very much, Carl.